Welcome to Grace Store. Today we are going to learn about merchandising accounting through a simple day at the store. We will follow Grace as she purchases merchandise, sells products to customers, handles returns and discounts, and finally prepares an income statement. Let's see how these everyday business activities are recorded in accounting. Grace Store is a merchandising business. Unlike a service company, a merchandising company purchases products and then she sells them to customers. These products are called merchandise. The basic process is simple. Grace purchases merchandise from supplier, keeps the products in her store as inventory, and then she sells them to customers. This creates a basic operating cycle of a merchandising business. So merchandise moves from suppliers to Grace Store and then from Grace Store to the customer. Accounting helps Grace to check what she buys, what she sells, and how much profit the store earns. The products that Grace owns and plans to sell to customers are called merchandise inventory. For Grace Store, the clothing on the shelves is inventory and is reported as an asset. Grace regularly checks her inventory levels. When inventory becomes low, she needs to purchase more merchandise from a supplier so that she has enough products available for the customers. Grace noticed that some items are running low, so she places an order with her supplier. A purchase order itself is not recorded as a journal entry. The purchase will be recorded when the merchandise is received. The supplier receives Grace's order and prepares the merchandise for shipment. At this stage, Grace has not yet received the goods, so we are not recording the purchase yet. Next, the supplier ships the merchandise to Grace Store. The goods are now in transit. The shipping terms will determine who is responsible for the freight cost. When Grace receives the merchandise, she checks the quantity and the condition of the goods. Because the merchandise was purchased on account, Grace debits merchandise inventory for $3,050 and credits account payable for the same amount. Inventory increases and the amount Grace owns the suppliers also increases. While checking the shipment, Grace discovers that 5 t-shirts are damaged. When merchandise is damaged, the buyer may return the merchandise to the supplier or receive an allowance. Grace contacts the supplier about the 5 damaged t-shirts. The supplier agrees to accept the return and gives Grace a credit. This means that Grace will now owe the supplier less money. The 5 returned t-shirts cost $150. Grace debits account payable for $150 because the amount she owns decreases. She credits merchandise inventory for the same amount because the returned merchandise is no longer part of her inventory. The supplier also offers Grace credit terms of 2-10 net 30. That means Grace can receive a 2% discount if she pays within 10 days. Otherwise, the full amount is due within 30 days. The original invoice was $3,050. After $150 purchase return, Grace owned $2,900. A 2% discount on this amount is $58. Therefore, if Grace pays within 10 days, she only needs to pay $2,852. Grace pays within the discount period. She debits account payable for $2,900 to eliminate the liability. She credits merchandise inventory for $58 purchase discount because the discount reduces the cost of inventory. Finally, she credits cash for the $2,852 actually paid. Shipping terms determine who is responsible for the freight cost. Under FOB shipping point, ownership transfers to the buyer when the merchandise leaves the seller's location. Therefore, Grace is responsible for the freight. If freight cost is $120, the cost is added to the merchandise inventory. FOB destination works differently. Ownership transfers when the merchandise reaches the buyer's location. The seller is responsible for the freight cost. And in this case, the supplier pays for the freight, so Grace does not add the freight cost to her inventory. Now Grace begins selling the merchandise to customers. In our example, she makes a $70 cash sale. Under a perpetual inventory system, selling merchandise has 2 accounting effects. we record the revenue from the sale, and we also record the cost of merchandise that we sold. The first journal entry records the sale. Because Grace receives $70 in cash, she debits cash for $70 and credits sales revenue for $70. This records the revenue earned from the customer. Now Grace records the second part of the sale. The merchandise sold cost the store $50. Grace debits cost of goods sold for $50 and credits merchandise inventory for $50. This records the expense and reduces the inventory that is no longer in the store. Let's put the two entries together. Grace earned $70 in sales revenue, but the merchandise cost $50. The difference between net sales and cost of goods sold contributes the gross profit. In this simple sale, the difference is $20. This shows why a merchandise sales requires us to consider both revenue and the cost of the merchandise sold. Sometimes a customer returns a merchandise to the store. This is called a sales return. In this example, the customer returns one t-shirt that was previously sold for $20. The original cost of the t-shirt was $15. First, Grace records the refund. She debits sales returns and allowance for $20 and credits cash for the $20. Sales returns and allowance is a contra revenue account, so it reduces the net sales. Cash also decreases because the customer receives a refund. Grace may also offer sales discounts to encourage customers to pay their accounts earlier. For example, 210 net 30 means the customer receives a 2% discount by paying within 10 days. If the customer owns $20, the discount is 40 cents, so the customer pays $19.60. When the customer pays within the discount period, Grace received $19.60 in cash. She debits cash for $19.60, sales discounts for the 40 cents. Finally, she debits accounts receivable for $20 because the customer's account is now paid in full. Now we can bring everything together in a multiple-step income statement. We begin with sales revenue. Sales returns and allowance and sales discounts are subtracted to calculate the net sales. Next, cost of goods sold is subtracted from the net sales to calculate gross profit. Finally, operating expenses are subtracted to determine net income. Gross profit is an important measure for merchandising company. Grace store has the net sales for $4,700 and cost of goods sold of $2,800. Therefore, gross profit is $1,900. After calculating gross profit, Grace subtracts the operating expenses of the businesses, such as rent, salaries, utilities, and advertising. Gross profits is $1,900 and total operating expenses are $1,650. This leaves Grace store with net income of $250. And that's the end of our day at Grace store. Chapter 5 shows how everyday merchandising transactions flow through the accounting system and eventually affect a company's financial statement and profit. Understanding this process helps us see the connection between inventory, sales, expenses, and net income. Thank you for watching.